Bismillah Rahman Rahim. Hello to all SBR students. A very warm welcome to my live session. The session is exclusively about SBR exam practice question. Exam attempt September-December 2024. Question name Kimimila company. 25 marks question, and very specifically examiner examine here two broader things. Number one, sustainable reporting, and number two, the implications of sustainable matters, the implication of sustainable matters to other accounting issues. So point number one, sustainable reporting, very particular, IFRS S2 climate related risk. Number two, sustainable related matters, accounting issues, the particular issue about IFRS 9, IS 12 and IFRS 2. Before starting the question, I must say here that I'm expecting that you people have already covered the material of sustainable reporting by reading the notes I've shared with you. In fact, reading and two small AI generated video that you people have already covered. This material you have already covered. And students, if you covered this particular document, this particular material, so and after that you have attempted that particular question, Kimimila company. So you feel that you must have to feel that this question is under the scope of this material. It's not outside the scope. That's a key point. So students, if you haven't covered the document, if you haven't covered the material of the sustainable reporting and not attempt this question here, you just pause the video, go back, first cover the sustainable reporting, complete material, do attempt this question and then start watching this video. Otherwise, you will not be able to get any advantage. Success you will not be able to get just watching the video. Before that, your effort counts, no? But the preparation about the topic, your self-attempt, and then watch that video. Okay, so assume that you have already covered these two things, no? Then I'm going to work out accordingly. Okay, let's start. The very categorically, the student must have to attempt the exam question in a way 20% of your time for planning, 80% for execution. 20% time includes reading, understanding of requirement and content. Number three, brainstorming. Before starting the question, you need to brainstorm the points. Number one. Number two, 80% of the time, based on the plan, you have to execute it. That's a point. So you must have to stick with that particular strategy. So let's start or apply all these points with this particular question. Let's start. Number one, briefly discuss how materiality approach is different in the European sustainable reporting standard compared to the IFRS. Means, and it's a very simple 2 marks question. In fact, I must say it's a very simple, very basic. The topic about materiality approach, and you need to answer the question, the difference between European standard and IFRS. 2 marks, and here mentioned that you don't need to refer any of the exhibits. So that means it's a very straightforward question. It's a very straightforward question. So if you face this type of the question, that's a very straightforward, not the case related, what you should do, you need to quickly attempt the question. Just need to attend the question. But how to attempt this question? The very first thing, the very first thing, you have to brainstorm. You have to brainstorm. You need to brainstorm. Huh? You need to brainstorm the point. That's a core point. That's what particular point that we need to cover here. That's you need to cover this point. Brainstorm. 1 minute. Yes. You need to brainstorm this point. Very specifically, as you know, the very quick, developing a mindset. IFRS, it's all about financial materiality. It's all about financial materiality. IFRS Sustainable Development Standard is all about financial materiality. So you need to answer straight that any climate related risk or any sustainable related risk, how that risk impact on the company's financials, P&L, state balance sheet or cash flows. That's simple. But on the other end, it's a two-way aspect about the European standard. European standard is about double materiality, financial materiality and impact materiality. Means that's double way, double materiality. The materiality is not only about any sustainable development risk about the financial of the company affect to the company, but also that's how company affect to that particular issues to the environment. So IFRS materiality is only about impact on, but European standard materiality is about impact on company and impact of company to the people and environment. So for 2 marks straight you need to mention is 2 points. Ideally, I must say, although it's a 2 marks, but you need to mention a very basic illustration as well. Basic, very basic illustration. For example, carbon emission or water usage. Okay, sir, can you please share me or can you please share us the answer? That's the answer the student can write easily. For example, very simple. One line under IFRS sustainable standard, materiality is a financial materiality only. Simple. Sustainable matter reported if that sustainable matter could affect the company's finance, means P&L, financial performance, balance sheet, statement of financial position or cash flow. Straight and add one simple example. For example, water shortage or carbon emission that may threats to the production of the factory. This should be disclosed because it affects the profits or the value of the inventory balance sheet, like this. So simple example. Number two, European standards apply double materiality. So you just refer the above point, means in addition. In addition means continue from the above. In addition to the financial materiality, entities also need to report impact materiality. Means how the operations, means how the company's operations. For example, the issue about the water, if there is a shortage of the water in a particular surrounding area, so the company operations affect to the people, society and environment by consuming the extra water or consuming the water. Example, if water use does not reduce profit, excess extraction harming local communities must disclose because it impacts society. Disclose in the case if company, if the company's activities affect on the environment. That's a point. So that's a very simple. You can ask me a question, sir, for 2 marks. We need to add example. Your model answer not mention the example, but I say yes, you need to make a quick example for clarity. No need to make the headings now here for only 2 marks. No need to make headings. Straight IFRS sustainable standard, European sustainable reporting standard. That's all. So that's a very basic point. So this is the first part. If you start reading the question and you just observe anything, a limited mark, you can easily park. So do it quickly. Then move on the rest part. Okay. Using the exhibit 1 only, exhibit 1 only. If it's mentioned exhibit 1 only, that means just read the exhibit 1 and then the attempt question related to the exhibit 1 and secure your 10 plus 2 12 marks here as well. Using exhibit 1 only, discuss why Kimimila company's sustainable report does not comply with IFRS standard. 10 marks, very substantial marks. And here 2 professional marks as well. So now it's time to read the exhibit 1 and then that's about reading requirement. Read the content based on the information. We can start the working accordingly. Yes, come on. I hope that you people have already attempted the question. If not, I must say that first of all, you need to attempt the question. Yes, come on. Kimimila company has produced a sustainable report. Okay. And the sustainable report states that it has been produced in accordance with IFRS standard. Okay. What was the question about? One minute. Okay, now, what was the question about? The question was about Kimimila company's sustainable report does not comply with IFRS. So, whatever you have read the requirement, based on that requirement, what the understanding of the requirement? That Kimimila company's sustainable report does not comply IFRS. So now you need, that means the requirement is something to identify. Listen carefully. Reading of the requirement and according to the requirement context, read the context is important. Because you have to plan and respond according to the requirement. So here you need to save time. Read the context according to the requirement. Here, requirement is something, the language about critic. or identify some errors, identify some issues. You have to read this content by identifying why and how Kimimila's sustainable reporting details are not compliant with IFRS S1 or S2. So it's not just about to read, you need to read the content according to the requirement. Are you getting the point? Do reply me. Are you getting the point? How to read the question? That's very key point. Okay, Kimimila company has produced a sustainable report. The sustainable report states that it has been produced according to IFRS sustainable disclosure standards. Due to a system issue, it was unable to capture important data during X7. As such, it is sustainable report covers 11 months. Means here you report the sustainable related issues, but your reporting is only based on 11 months data. You have some limitation that's, or you have some issues that you couldn't able to find out or get the data of last month. So other than accounting, other than sustainable reporting, if we apply this point, for example, with the revenue, we have reported the revenue, but due to some reason, last month revenue data we haven't able to compiled. But we reported this year only 11 months revenue. Is this the right thing? No, not at all. You have to get all the material, all 12 months, 365 days material with the accuracy, relevance, reliability, honesty, and all the conceptual framework principles, faithful representation, and the relevant. So the first point, it's you need to highlight. First point you need to highlight. So you during the reading you need to brainstorm the point. Na? Brainstorm. During the reading you need to brainstorm. Yes or no? You need to brainstorm. The first brainstorm point, IFRS sustainable reporting, general disclosure by S1. First, the general disclosure by S1. Same reporting period as financial, 12 months, not 11. So the first point in your mind that's established, that's brainstorm. Number two, in its climate related disclosure, Kimimila company has identified several climate related opportunities. Several climate related opportunities. It has also identified climate related physical risk, but not other type of risk. Other type of risk? Can someone respond me? What is the meaning of other type of risk? Other type of risk with a sustainable development. Very good. Must disclose physical and transaction risk. Transaction risk. Physical and transaction risk. For the risk and opportunity identified, Kimimila company has disclosed the potential impact of financial position performance over the next 12 months. Here the disclosure is only about that what the climate related risk, the physical risk, and opportunities identified, or whatever the risk and opportunity identified. Here the disclosure is only about the potential impact over next 12 months. Here is the concern point. Do remember the very important point. You need to disclose the risk, climate or other sustainable related risk implications to the company, not with the short term of the next 12 months, but short term and the long term as well. Short term and the long term as well. So implications for next 1 year and more. So that's another point. Impact of disclosure, short, medium, long, not just 12 months. That's a point. Next, Kimimila company disclose its scope 1 greenhouse emissions. Scope 1, the disclosure is about metrics. That's how much emission you created based on scope 1, scope 2, scope 3. Scope 1 is about the company involved for climate related risk like gas emission directly. This is a company that's, as you know, that this particular company is about the manufacturers of petrol car engines. So whatever they are using the machineries and create the pollution, that's called S1. That's called S1. If they consume the electricity, so electricity consumption matters. That's about scope 2 greenhouse gas emission. And if the company supply chain, for example, supply chain transporters or like this, creates the uh, emissions, that's called scope 3. So all three need to add on. So here, Kimimila company disclosed the scope of the greenhouse emission, scope 1 only. It has not disclosed scope 2 or 3. On the basis these figures are difficult to measure. So Kimimila company believed that this level of measurement uncertainty would not be useful for the primary use of the financial statement. This is not the justification. This is not the justification. This is not the justification that we will not disclose because that's not relevant for primary user. You have to disclose the metrics of scope 1, scope 2, and where possible scope 3. Student, I know that if the student face difficulty with respect to these points, the climate related risk and opportunities. Number one, the, the about physical and transaction risk. If you face difficulty, you have to cover this topic. My notes, sir, what is this about? IFRS S2, one or two or three pages about climate related disclosure. Number one, you need to identify the risk any of the company. For example, this is a Kimimila company. What they do? Produce petrol car manufacturing. Number one. So first, how the climate risk affect to the business. So first of all, need to identify risk. First, there are two risks: physical risk, yes. Number one, physical risk. One minute. One minute. Yes. Number one, physical risk. This is physical risk. That is about the physical risk. The first thing. Physical risk include acute risk and chronic risk. Acute means one-off risk. One time flood, one time wildfires, one time tsunami. Allah forbid. That is acute physical risk. How that physical risk affected to the company. And chronic risk means long term. That's permanent change in the climate change. How permanent change in the climate change affect to the business. This is about the physical risk. So here examiner not asking to identify the physical risk. No, here mentioned, yes, they have disclosed the physical risk, but listen carefully. They don't disclose the transaction risk. Sir, what does this mean? Transaction risk. The risk that arise from effort to transaction. Effort to transaction. Efforts to transaction to lower carbon economy. For example, if government announce the policy, low carbon economy, and restrict the for example, restriction, creating or making a policy for making a policy about a restriction over petrol engine cars and promote more about electric vehicle, e-vehicle. So that means this is not physical related risk. This is transaction risk, low carbon economy. Transaction risk include policy, legal, technological, market, reputational. That's called transaction risk. My material includes a lot of examples. Key type of transaction risk: reputational risk, policy and regulation risk, technology risk. For the new development of the technology, maybe your business model is no more successful or sustainable. Market risk, the behavior of, for example, consumer preferences now become changed. This is one of the example. In fact, multiple examples. What are the possible climate related risk? For example, a company, an entity called resort and located coastal city. What are the climate related risk and opportunities? Is this transaction risk or physical risk? Absolute physical risk. Absolute physical risk. But maybe for legal and so many matters affect the transaction risk as well. Students, number one, the very important point, you need to refer the point. The first point is about climate risk. You have to disclose the risk management matter, what the risk have, how this is affected in terms of transition or physical. The first point. Number two, you can review the IFRS S2 content. You need to disclose governance, strategy, risk management metrics. But here, examiner not ask about governance, strategy, like these things. But here, examiner examine about metrics. What metrics? Very simple. Metrics means measurement criteria. How to measure and report the sustainable related risk. Here, the climate risk. The metrics of climate risk is about, let's suppose, scope 1. Scope 1, the Kimimila company has made the disclosure. Direct emission from sources owned or controlled by entity. That's they have disclosed. Direct emission by making of the petrol car engines. But scope 2, indirect emissions. Scope 2 and 3 are indirect. Indirect emissions from purchased or acquired electricity. They are not actually creating the emissions or pollutions, but they are using the electricity. They are using the heating, cooling system. That's called indirect emission. and more indirect emission, that is scope 3, that occur a value change. That include the, for example, you purchase, for example, some raw material from your vendors, and the vendor provide the transportation, and that transportation create the emissions. That's called scope 3. So why we are studying this? We are studying this because here is the requirement of the IFRS S2. You need to calculate the total metrics, total values in numbers and ideally in dollars. How much your business involved in creating the emissions in terms of scope 1, 2, and 3. Must have to scope 1 and ideally for scope 2 and 3 as well. So here is, you need to quick make a reference. If you are not able to recall the content, recall the material for these two para, then move on. Okay, so these are the issues. Quickly, what we have identified, that not able to means brainstorming these 3 points. Reporting data based on 12 months, not 11. Must disclose a physical and transaction risk. Impact disclosure means what will be the impact of this risk, this climate related risk, not the short term but long term. Scope 1, 2, 3 emissions required with the guidance. Also, here is some uncertainty about the measurement of the emissions. Must disclose the method and assumptions. Okay, now come on. Next point. Several years ago, Kimimila company introduced share-based payment, IFRS 2, scheme for its directors. The option would vest 31st December X7. 31st December X7 this year. The question year end is 31st December X7. If Kimimila company cut its scope greenhouse emission by 10% per year on average, this target was not met. Not met. One thing, if I'm asking you, the target is about the greenhouse emission. Is this market-based target or non-marketable? Marketable condition, non-marketable condition. Marketable condition, non-marketable condition. IFRS 2, recall IFRS 2. Is this about marketable condition, non-marketable condition? Marketable, non-marketable. Marketable, non-marketable. Do reply me. Yes, this is non-marketable. The condition to vest the share option here, that's non-marketable. It's non-marketable. Very good. And the scheme did not vest. No mention is made of share-based payment in the climate-related disclosure. Oh, if something attach the bonuses and all these things, about the sustainable reporting, you have to disclose it. So one more point, target disclosure of greenhouse gas emission reduction target and share-based payment not met. You need to disclose it. Further, the climate-related disclosure details Kimimila company target of becoming net zero within the next decade. You need to aware about what is the meaning of the net zero. Net zero means, if ideally the company, it's not the compulsion, it's a voluntarily work. But the company has announced the policy about the net zero. Net zero means, for example, if a company accept that we are involving or our operations operations affect to the society or environment, for example, carbon emissions. So equally, we have to participate socially or environmentally to support that. For example, by purchasing the credit. By purchasing the credit means, for example, purchase the credit for some charitable work. Purchasing the credit by plantation, foresting, free farming. So at one side you are creating the emissions. So one metric is about 100,000 tons creating the emissions, for example. Other side, your role by purchasing the credit for purchasing credit in terms of charity, in terms of plantation. So you wanted to make up target of net zero. Whatever the emission we are developing, simultaneously we are also working for green environment. Creating emissions, other side green environment. So that means net zero. So the climate related disclosure details Kimimila company target for becoming net zero within the next decade. Around half of the anticipated carbon reduction is estimated to arise from carbon credits. There is no reference to use of carbon credits to the disclosure. If you disclose something about net zero and you estimate that net zero, it's based on purchasing the credits. So you need to disclose this point. You need to disclose this point. Students, here you have to remember point. There are two ways. There are two ways to meet the target of net zero. For example, if your company creating the pollution, or that's called greenhouse gas emissions, involving an emission of the greenhouse gases. So you wanted to work out for the net zero. You have measured with some metrics that 100,000 tons with scope 1, 2, 3. 100,000 tons gas you emitted. So how to become net zero? Option 1. You have to develop a policy to replace your machines, for example. The machines, and invest for the machines where the machines do not create or create lesser gas emissions. Number 1. So here the option 1 is about to become net zero, to revise your business operations, revise your business structure. On the other hand, you are less focused for revising the business operations, replacing the machine or no, and more. But simultaneously, you involve with charity, plantation, these type of work. So the second option is that you are creating the pollution, creating the gas emission, and simultaneously involved with the carbon credits in term of plantation, better environment, foresting. So this is the other point to become net zero. So there are two possibilities. Here, their policy, it's not about to change operations and become net zero. The operations still continue to create the gas emissions, and they have calculated the gas emissions in terms of scope 1, 2, 3. Simultaneously, they are involved by purchasing the carbon credit, better environment, foresting, plantation. That's why it's mentioned that around half of the anticipated carbon emission reduction is estimated to rise from carbon credits. Half. So they are actually creating the net zero by carbon credit, but they haven't disclosed this point. That's a point. That's true. So you need to develop a mindset that carbon credit 50% reliance. For net zero, carbon credit 50% reliance. Must disclose this type. This must disclose this, because it will show your credibility and integrity. So this is about the brainstorming. Student, are you with me? Can you please reply me? How I have covered this content. Read and brainstorm simultaneously and refer your knowledge. So whenever you are practicing any of the question, not the sustainable reporting, if You are attempting the question and you feel that you have you don't have some idea, or you are blur, or you have um, lost your mind about some points that particular related to that material. You have to refer the content and then complete the question accordingly. Okay, what's the smart answer? Here is the smart answer. Based on the points, based on the above points, based on the above points, 6 or 7 points, stick your plan, stick your strategy. That's the answer. Reporting period. No need to make a heading, it's just for your convenience, just for your support. 1 point about reporting period, the risk disclosure. It's not about the physical but also transition. Greenhouse emission, gas emission scope 1 and scope 1 to 3 as well. The targets, carbon credits, net zero. That's a point. That's a smart answer for you. I'm not reading the content here. You just refer the solution. That is exclusive for you. Huh? I made a lot of effort for you. Here is some exam tool. Exam tool means I have extracted some point from the examiner report. You need to refer this, no? That's very important. Examiner says, that examining team, about this case, many students lose marks by only talking about emissions, but forgetting transition risk and targets. Be relevant. You have to answer the question that's relevant. Even if scope 3 is exempt in year 1, scope 2 disclosure is compulsory. Easy marks. That's easy marks, scope 1, scope 2. Always, never, never think about that. You just write the general answer. You need to link with the case. Always link each weakness. Weakness means here you have identified the case. The requirement is about identify the flaw of the disclosure. So here examiner says always link the case with IFRS 1 and S2. If you do that, you will earn the professional marks. What is about the professional marks? Because this is about investor perspective or reporting perspective. The answer must be clear, well structured answer. That means each answer must be splitted, separated, specific to S1, S2. You don't refer any other standard here. Concise and exam style drafting. Student, can you please reply me? Is this document, it's and the discussion, it's worthful for you, whatever we are doing right now? Is this the answer well structured according to the student caliber? Not about the model answer. That's the point. You have to learn the things from here and apply accordingly over the period. That's important. Okay. Now this is the part about requirement A2. Now, what about the requirement B? Further, using exhibit 2, to discuss the impact of climate change on the following issues. Don't worry about that. If the examiner asking about impact of climate change on the issues of the financial asset, it's not something about change with the IFRS 9. No. You have to apply the IFRS 9, the aspects related to the climate change. So financial assets that 31st December exempt, deferred tax, and okay, one by one. Kimimila company is currently assessing the impact of climate change in the financial statement. Number one, very simple. Financial asset. Kimimila company has extended the loan to its key supplier. So basically, they have provided loan to the supplier. And this is the financial asset. Okay. So develop the mindset. Financial asset, loan receivable here to the supplier. Loan receivable to the supplier. So transaction is loan receivable, financial asset. Extended the loan to key supplier to help ensure that viability. Okay. Kimimila company has recognized the loans as a financial asset. Kimimila loan company loan holds loan for this type with the intention to collecting cash, contractual cash flows. What is this about? If the business model if the business model is about the cash flow characteristics, so financial asset must have to be reported according to amortized cost. It's simple. It's not a non-marketable financial asset. It's simple loan to the supplier. And the accounting treatment here, financial asset by amortized cost method. Number one. Number two, financial asset with amortized cost method, you have to consider the credit loss and where required. In fact, you have to assess the credit loss and make a allowance for the ECL, expected credit loss. And the time by time, the ECL requirement become changed. That's stage one, maybe stage two. In this case, it's nothing about stage three. That's the point. It's very simple. But here the changes about the ability of the borrower to repay the amount. Here the borrower is supplier to repay the amount. We are lender. Very clear. So ability of the supplier to repay to the Kimimila affected some climate related matter. Kimimila produced the cars, manufacture of petrol cars, and the vendor also associated with supplies of the petrol car engines and so on materials. So now read it. Kimimila company and its supplier have been affected by wildfires and flooding. Okay, is this the point? That's affect to the credit loss calculations or allowances? Yes or no? Yes. If climate risk affect to our borrowers, we are lender, borrower supplier, so their ability to repay the amount, it's affected. So that will affect to the IFRS 9 credit loss or ECL matter. In addition to this, there have been considerable policy and regulatory change which affected all parties. That's called transition risk. Transition risk. That's also affect to the businesses of petrol engine manufacturers. Significant uncertainty exists around the impact of climate change scenario on Kimimila company and suppliers business model as well. The question is very focused about financial asset. So effect of climate related risk to the supplier and then supplier's ability to repay to the Kimimila. That's a point. So important point is that this climate related risk, specific risk, wildfires and flooding. Wildfire and flooding. What is this risk? Do let me know. There are two categories of the risk: physical risk and transition risk. Can anyone reply me? How to identify which one is the physical, which one is the transition? Can anyone here identify? Yes. Wildfires and flooding is specific, that's physical risk. Policy and regulatory change, that is about transition risk. Hello, are you with me? Are you getting the point? These two climate related risks affect to our borrower, that is supplier, and that affect our financial asset matter. If yes, then do reply me. That's important. Just as limited persons are replying. Okay. So brainstorming. Number one, that's a 4 marks. But the quick point, number one, we have to start loan to supplier, a simple one line measurement or accounting amortized cost, and simultaneously apply the impairment model ECL. Here, the specific climate change, wildfires, flooding, regulatory shifts. You have to mention. You can also mention that physical and transition. That's increase the supplier risk. Consider whether significant increase in credit risk or credit impaired. Significant increase credit risk and credit impaired. That's a point. If significant increase, and also the security may also lose value due to climate impact. The security from the supplier. IFRS 9 requires forward-looking info, include climate-related data in ECL model. So this is the 4 marks. Very simple 4 marks. Very simple. The loan are measured at amortized cost, and IFRS 9 impairment must apply ECL, and then climate risk. 1 marks, it's simple 1 marks here. And number two, 3 marks about the climate risk. Credit risk assessment, significant increase, credit risk. Although it's not categorically mentioned in the stage 3, but stage 2 is relevant. Collateral impact, supplier asset use security also affected by climate change, recoverable amount decline. ECL, IFRS 9 required forward-looking assessment, all reasonable supportive information. Climate-related scenario must be incorporated. Factor means incorporated into cash flow projection and probability of default. Kimimila may need to record high loss allowance, 12 months ECL lifetime ECL to reflect the increased exposure to the credit loss. That's a point. Some exam specific point. Examiner wants to link climate issues, IFRS 9. That's important. Expect that. Do not just say wildfires and flood are bad. This is not the journal. Very important for you. If you just mention these are bad things, you will not be able to mark. Relevant. You are setting with the examination, with the application, with the SBR. Tie them means link them to the credit risk and the collateral value. Collateral means if supplier collateral with some assets, so climate related matter affect that collateral values and affect to the credit loss. Short 3 to 4 sentence answers can score well. It's not necessary that you have to write a detailed answer. Limited answer, reference of IFRS 9, and then make 1 paragraph. That's all. I will guide you more about this 3 to 4 sentence answer. Next part of the question. Okay, class. Are you with me? Can you please apply? How the sustainable reporting matter examine, and how you should have to plan and execute the answer. What about the examiner report extract? All we are covering here. Okay, next point. Deferred tax asset. Recall your knowledge. Deferred tax asset can be recognized where the expected future taxable income profit are expected. There is about a probability about the future expected profits. Okay, deferred tax asset. Kimimila company has been loss making for past 2 years. Loss making. Okay, past 2 years. These losses can be carried forward to reduce taxable profit in the future years. Kimimila company has recognized material deferred tax asset. As you know that if for carry forward or unused losses, you can recognize the deferred tax asset if the IS 12 conditions meet. One of the most important condition is that the expected future taxable profit. Many of the Kimimila company suppliers are incurring cost. Now, we need to assess the situation. What situation? We need to assess the situation. If the carry forward losses exist and you are making a deferred tax asset, what is the probability about the expected future taxable income? If there are no possibility about the future taxable income, it's not possible to recognize the deferred tax asset. So here is the connection. If climate related risk implications is a long term and there is a question mark about the company's profitability about the future, you cannot recognize a deferred tax asset here. So that is about the connection of the deferred tax asset with the climate change. Next para, this is the point. Many of the Kimimila company suppliers are incurring cost in order to reduce carbon emissions during the production process. This will cause purchase price of raw material used by Kimimila company increase. So if supplier incurring costs to reduce carbon emissions in the production process, and based on that production price become increases, and that affect to the Kimimila, so that means Kimimila raw material price become increases. So this is the first factor that the expected future material price will increase. Previously, we have already made that. The Kimimila have already made the loss. Number two, due to increase in the popularity of the EV, electric vehicles, Kimimila company has forecast a decrease in demand in many of the production lines. There are two serious issues, two serious risks and their implications: raw material prices and the demand of your product. Come on, what do you will say about the IS 12? What do you say? Is there a question mark of the deferred tax asset? Yes or no? Is there a question mark of the deferred tax asset? Yes or no? Do reply me. IS 12 deferred tax asset. Number one, brainstorming. Recognize if probable future taxable profit exists. That's always start with basics. Kimimila making loss last 2 years. Climate risk, higher supplier cost, carbon reduction. Now the implication of climate risk, higher raw material prices, low demand for the petrol engine, shift to EVs, impact, less certainty about the future profit. So that's harder to recognize, justify the recognition of IS 12 deferred tax asset. So here you need to de-recognize the deferred tax asset. And that is what about the answer. Number one, IS 12 principle. Number two, application to the Kimimila. You don't need to make heading. First para, first line about IS 12. And then all these points: loss making for 2 years, supplier cost, failing in demand, reduce or de-recognition, deferred tax asset, all these things. Exam 2 for IS 12. Here, deferred tax asset, probable future profit test, climate change factors. Here the point, even short precise answer can pick full 4 marks. This is not necessary that you have to answer the question in this way. You can draft the answer in this way as well. Simple, smart. Under IS 12, deferred tax asset recognized only when probable taxable profit available unless losses and temporary difference. Sorry, to utilize the losses and temporary difference. Kimimila loss making for 2 years, casting doubtable profit, doubt on profitability. Future profits are further threatened by higher supply cost for carbon reduction measures and reduced demand for petrol engines, shifting to the e-vehicles. Given these related uncertainty, it may not be probable that sufficient taxable profit arise, meaning Kimimila must reduce or de-recognize the after tax. It's not necessary that you have to draft in this way. Straight this this parabase you can work out. Candidates, are you with me? Do reply me. Now the last part about the share base. Give me a just take a 2 minutes break. 2 minutes short break. Okay, class. All available. Now we are going to resume the class. Huh? Uh, okay. Next point. Using the exhibit 3 in accordance with IFRS 2 share-based payment, how share-based payment should be accounted for in Kimimila financial statement for the year end 31st December X7. IFRS 2. Here the case is about non-market based condition, huh? And something also about vesting at the final date, vesting conditions not able to meet. So there are two things that need to consider. First, accounting for the vesting conditions over the period. And number two, at the end of the day, that 31st December X7, all the accounting must have to reverse. So let's start. 1st January X4, 1st January X4, 4, or now 7, 4, 5, 6, 7. Kimimila company introduced share-based payment scheme for its 10 directors. Each director was granted 15,000 shares. 15,000 shares. Fair value of option at this date was $8. Option would vest 31st December X7 if Kimimila company cut its scope 1 greenhouse gas emission by average 10% per year over 4-year period. Okay, so originally that was decided at 1st January X4 that 15,000 share options and the option value at 1st January X4 determined $8 and vesting time 4 years. Vesting condition non-market, that's 10% reduction in the scope 1 of the carbon emission. Okay, now the second point, 31st December X6 means 4, 5, 6. The 3 years base, over the 3 years, none of the director had left Kimimila company or were expected to leave in the next 12 months. So if we assume that we stand at 31st December X6, 3 years has gone, accounting till 31st December X6 must be based on 10 directors, number one. Because no one assuming at 31st December X6, none of the director had left, and at that 31st December X6, they were expecting that no one will leave within the vesting period remaining 1 year. So based on 10 directors, multiply by 15,000, multiply by $8, and multiply by 3/4 at X6. Huh? So Kimimila company was on track to meet greenhouse gas target. Was on track 31st December X6, meaning that share option were expected to vest. Share-based payment scheme was correctly accounted for financial statement 31st December X6. So what if I ask you what was the accounting they did till 31st December X6? So we have to develop the mindset 15,000 multiplied by 10 directors into $8 multiplied by 3/4. That was the story till 31st December X6. But now are standing at 31st December X7. 31st December X7, due to unanticipated changes in production process, greenhouse target was not met. So that means here at that date, we have to reverse the accounting. But the point is that all of these working, and the IFRS 2 non-market based condition we have to portray. So during the discussion, what the mindset we have, That is equity settled share based payment, number one. It's not cash settled, it's not combination. Equity settled option value granted $8, best investing over the time period, that's 4 years. This is the non-market performance, that's emission. First, we have to explain 31st December 6, we're expected to vest. So recognition to the date of 31st December X6, that we need to report it. And 31st December X7 target not met. So that means reverse all the recognized cost. Students, that's the answer. That's the answer. I'm not reading the answer here. I'm expecting that you people have covered it. If you not, you have to refer this thing. All the matters I have covered, IFRS 2, non-market condition, calculations, reversal, all these things. It's very simple. Exam key point. Exam key point. Exam key point. Examiner mentioned that this is the non-market condition. That's not met, reverse all expense. In the case of the market condition, we don't need to mention here. So we have to complete the reporting of the market condition, even the condition not meet, because the market condition matters at the grant date normally for sure incorporated the probability yes or no. So it's very simple. Always show the quick calculation. To park the marks means to bank the marks. That's option fair value multiply by elapsed. Elapsed means previous year the 3 years has gone, divided by vesting, that 4 years. It's very simple. So that is all about this answer. That's covered accordingly. That's all. So this is all about it. Yes, there's a question. The question is about इसमें हम 1 जनवरी 2003 what is this 1 January 2003? What is this about 1 January 2003? Why? This is the question start from 1 January X4. So why we are working start with the 1 January X3? I'm not getting your point. Yes, for sure. At the date of the reporting, 31st December X6, the accounting starts from 1st January X4 to 31st December X6. You don't need to mention the X4, X5, X6 working. Directly, the working directly here. Listen carefully. Cumulative expense till 31st December X6. Cumulative means total year 1, 2, 3, 4, 5, 6. That's 150,000 multiplied by 8. 150 means 10 multiplied by 15,000 into 3 over 4. So it's a cumulative expense. Na? Total. Is this clear? Total P&L and total equity. You don't need to make a table accordingly. It's direct work. So student, that is all about this particular practice session, Kimimila. Thank you very much. Take care a lot. If you have any query, you can ask me on the WhatsApp. Thank you. Take care a lot.